Importance of risk management. Very true. Risk management is there to help you protect your capital and minimize losses. Because in trading, not all trades are going to be winning trade. There are going to be some that are going to be losses. Every trade should have, let's say, your trade could either have 5 outcomes, which is small loss, big loss, small win, big win, or break even. Now, to ensure you don't have a big loss, because if you can take away this fifth, that is the big loss, then over time you can be profitable. You need risk management. Without risk management, you can blow your account. With proper risk management, it makes it more difficult to blow your account. Treat trading as a business. Take calculated risks. Take risk management very serious. It enables you protect your capital and enables you stay in trading for a long-term plan. All right. So risk management is what defines you as a trader, is what sets the winners apart from the losers. So many traders are losing it. So many traders are making it big. But risk management is very important. Even though your win rate is 50%, with a proper risk management strategy, you're still profitable. We'll go more into risk management, but this is the fundamentals. All right. Now, an acceptable ratio is typically 1 is to risk and 2 is to reward, or even higher. Meaning, for every $1 you risk, you're expected to make $2 in return. If you're risking 10% of your account, you're expected to get 2% out of that trade. Now, when you see a trade playing out in a certain direction, use your risks. Don't just go all in. Divide it. Tell yourself, okay, I have $100 in my account. I want to risk 10%. Risking 10%. How much do I stand to gain? If this market can give me at least 2 times of my risks, then it is worth an entry. But if a market is not giving you at least 2 times of your risks, then avoid it. Okay? So a good risk to reward ratio, minimum, at least an expected ratio, highly recommended. 1 is to risk and 2 is to reward, or higher. So these are the fundamentals. This over time keeps you profitable. If your win rate is 50%, statistics has shown that even at the end of the month, even after 10 trades, after 100 trades, you can still pull up a 50% return of investment on your initial capital while trading with 1 is to risk and 2 is to reward at a 50% risk to reward, at a 50% win rate. Now imagine if your win rate is even more higher, that ultimately puts you in profit. Without proper risk management, there are situations whereby you can have, let me say, 5 consecutive winning trades and it takes just 1 trade to blow it up. Or even there are these situations whereby for 2 weeks consecutively, you're having good wins, good wins, good wins. There are times where your strategy doesn't print out good trades. Not that your strategy doesn't print out a good trade. There are times where the market could just go against you, and without proper risk management, you don't want to lose all your hard work or your effort in just 1 trade. So risk management is very important. It is the lifeblood of the market. So you need to inculcate the proper risk management. As a beginner, no matter where you are, even as an advanced, let this sink into you. At least 1 is to risk and 2 is to reward. If you're not getting that from a trade, then move on. That trade is not worth taking. All right. So now moving forward, how we calculate our risks, how we able to manage our risks with stop loss. Ensure you always put a stop loss. No matter how confident you are about a trade, make sure you have a stop loss that doesn't let you lose more than you intended. All right. Now look at this scenario, a buy order with a stop loss. This is where you're going to lose, just from here to here. But when you don't have a stop loss in place, your account can get blown. You can get to lose a lot. So risk management enables you to avoid losses. Stop loss is there to cut a loss, even when the markets, even when you're not observing the markets. Avoid all this mental stop loss that beginner traders do. Don't go mental on this. Use the proper stop loss based on what the market is presenting to you. Because if you're using a mental stop loss, chances are that when the trade begins to go against you, you let it keep on running and you hold up on a loss. At the end of the day, your margin is just down before you need to get margin called and you blow your account. So avoid this thing we call mental stop loss and use a fixed stop loss based on what the market is telling you, and use a very calculated lot size to ensure that you don't risk more than you're willing to take. All right. And then we also have take profit. Always have a take profit. Always have a target, because you cannot just be in the market forever. Trends don't last forever. So have a take profit. When that take profit is achieved, your profit is secured or you close your trade. So ensure you have a take profit and a stop loss order in place whenever opening a trade. Now, position sizing. Also, you have to manage your positions based on lot size. Let me say I have $100 in my account and I'm willing to risk only 10% of my account per trade, 10% of my account per trade. And I see a trade that is giving me, let me say, the stop loss could be 20 pips stop loss. making that calculation, that is to say, I'm willing to use let's say 20 pips stop loss, I'll use 0.05 lot size. Using 0.05 lot size, if 20 pips stop loss should go against it, what is that, guys? That's $10. Then you know you're not losing more than you intended. You can have more calm and you can be less emotional and not panic and let that trade run for you. So risk management is very rushed through, but pick out the points, read behind the line. Never forget this. 1 is to risk and 2 is to reward. Always use your stop loss, always use your take profits. Very good. Moving forward, this is a chart that shows us something. If you're risking 1 to get 1, then your chances of winning and losing are about 50%, 50%. The only way you can be profitable is if you have a good win rate that is above 50%. Else, you end up being a drawdown trader if you're lucky. Unfortunately, you can end up blowing your account. So ensure you use 1 is to risk and 2 is to reward. And also, or if you have a good opportunity to go higher, depending on the opportunity the market places at your feet, then you can go for 1 is to risk, 1 is to risk, and 3 is to reward. That is to say, if you're risking 10%, you're expected to get like 30%, or if it's 1 is to risk and 2 is to reward, you're expected to get like 20%. And that's how you can go about your trading, not losing everything in one day. All right. So stop loss and take profit diagram. This is it. This red zone here is our stop loss, and this diagram above is our take profit. This is giving us a good risk to reward ratio of 1 is to risk and 1.2 and 2.5 is to reward. All right. So this is a good type of trading scenario you should take. Now, still moving on forward, this is an exercise to ensure that you're actually learning and building up, because we're not just here to learn and learn. You need to practice the way you make improvement. Not that you're not going to fail, but in your failures you learn better and then you keep on pushing forward. So you need to really take this exercise down. Okay, don't feel uncomfortable. Do the exercise, learn from your mistake. When you're wrong, we can always correct you. That is why I have a community backing you up and taking you forward. Now, calculate risk to reward ratio for a given trade scenario. You can just go around, check a trade, analyze it. What is a risk to reward ratio there? Is it 1 is to risk and 2 is to reward? It's not difficult. Even from our previous trades that we have taken before, practice stop loss and take profit levels on a demo account. It's very important. On a demo account, ensure you practice it, because a trader that doesn't trade without a stop loss and a take profit is not being intentional. You have to be very intentional about your trade, about your business, about everything you do in order to see sustainable profits and to increase. Remember, psychology is the most important thing in trading. Like, you need to have the good fundamentals. You need to have the good mental practice. So this ensures, risk management ensures that in the long run, you can be profitable. Imagine if you're risking only 10% of your account per trade. It takes you 10 trades to blow your account. You cannot be a trader and have 10 straight losses. If you have 10 straight consecutive losses, you ask yourself, what is going on? Even though you're using a coin toss, heads or tails, guys, heads or tails, according to probability and statistics, it says 50% is heads and 50% is tails. Even though you're using that, statistics has shown, and as I've seen before, this was over 2 years ago, using that to even decide heads I'll buy, tails I'll sell, and you have a good risk to reward ratio, you're still going to end up in profit. So risk to reward ratio is very important. All right. So additional resources you can go and read from Baby Pigs to improve yourself on risk to reward risk management. Also, you can communicate with us here, and we can always be here to guide you. Wonderful. Now, this is an also assessment. Okay, so to understand, to ensure that you understand the basic concepts, review your model 1 and test your understanding. Okay, identify support and resistance levels as we spoke about in our previous session. Also, candlestick patterns on historical charts. Go back the different time frame, just go back to what has already happened, identify support and resistance, and identify the chart patterns. This will really ensure that you are actually learning and growing forward. Beautiful. Now let's go on with our model 2, which is we'll go into a deeper exploration into advanced charts, patterns, and technical indicators for refined trading strategies. What we did was just we're still going in deeper and deeper. The overview of what I'm meant to talk about in model 2, advanced charts, patterns. We'll talk about the head and shoulder pattern, double top, double bottom, triangle patterns, symmetric, ascending, descending triangle. All these are beautiful concepts I love to see, and you see them happening a lot in the market. We also talk about indicators. People love this. Indicators. Now we'll talk about indicators. We'll talk about the moving average. We'll talk about this relative strength index, which is RSI. We'll talk about the moving average cover MACD. We'll talk about that's MACD and divergence. Talk about Bollinger Bands. We even talk about Fibonacci retracement and expansion here. All right. Moving average convergence. All right. Now, advanced candle patterns. Okay, just it's not so advanced. That's the term. You're no longer beginners anymore, but we're moving forward. All right. Now, whenever you notice a head and a shoulder, something that looks like a head and a shoulder from the chart, here we have the shoulder, the left shoulder, we have a head, and we have a right shoulder. Whenever this happens, okay, it is if it's happened in an uptrend, then that is a potential for a downtrend to come about. All right, the market's structure has shifted, telling us that okay, this market is losing momentum to buy, thereby saying that sellers are actively entering this market, and this market is most likely going to sell. It consists of 3 peaks. Okay, the highest peak is the middle, which is the head, and then 2 by the left and right. We call it the head and the shoulder pattern. Okay, traders typically enter a short position after this pattern completes, not before it completes, but after it completes. Okay, and then price, that means after the price breaks the neckline, that's when we traders tend to enter this trade and go for it. Also, double top and double bottom patterns. This is another one. Whenever we have a double top, okay, double top tells you that the market wants to sell. You only enter after the neckline has been broken, and then the double bottom tells you that this market is about to appreciate. Then you only enter also after the neckline has been broken. I see a lot of beginner traders entering before the neckline is broken. Don't do that. Always enter after after the neckline has been broken. This improves your odds and probabilities of winning in this trade. Okay, so double top tell you, okay, this market is about to sell. You only sell when the neckline is broken, and then whenever you see a double top, double bottom, somebody call it a W pattern, yeah, double bottom, that means this market is about to increase, appreciate, and you only enter after the neckline is broken. That's it. Moving on forward, see, everything here has been made easy for you to understand. Forex is not difficult. You have to understand it properly. Give your time to study, to learning, refining, and improving yourself. Okay, so we have triangle patterns. Okay, we have the symmetric triangle. It's a continuation pattern formed by converging trend lines. Okay, it could be a sign that the bears or the bulls are in control. You will not really know until after the breakout. Okay, all right, these breakouts can either confirm a continuation in trend or a trend reversal. So whatever it is, when you notice the market wants to form a triangle, just use your trend line tools to draw it around and wait for it to break. Typically, you want to enter after a break and retest, or even a confirmed break, just enter and you sell. That's just it. You don't have to memorize all these triangle patterns in your head. Just know that whenever I see the market trying to form a triangle for me, I will just draw my triangle, wait for it to break. When I get a confirmed break, then I take a sell. Also, that's how it is. All right, so ascending triangle, as what said, ascending, even from the way it is, you see, begins to ascend. Here there's like a resistance, and then it begins to ascend. Eventually it tends to break up to the upside. When it breaks to the upside, you take your sell trade, you take a buy trade here, and your stop loss here, and you target the next significant high wherever that is on your chart. Yeah, now we also have a descending, as well as a descending, a triangle that, like a descending triangle. This is it. It has, the bottoms are about the same level, and then the highs keeps on going down, keep on creating lower high, lower high, lower high, lower high, but the bottoms are about the same thing. You just draw a triangle, wait for it to break. Ultimately it leads to a down trend, and that is how you take your trade. So remember what I said, guys, in our previous class. Candlesticks, they are the psychology of the market. So your ability to understand these candlesticks enables you to communicate properly with the market. You have to be a very good listener. You have to be a very good market whisperer in order to be a very good technical analysis, in order to be a very good financial analysis in the Forex market. This analysis we're learning, you can take it in any other financial class, be it the stock market, be it a commodity, be it crypto market, be it currency pairs. All right, so these are fundamentals to analysis. So take this serious. Anything that is not sure to you, you can always go back to rewatch this video, or you can always drop a comment. We're here to answer. All right, now this is the neckline structure. Okay, visual aid to help you out. This is it. We have a chart, clear chart. The market came in. This is a peak. We have the shoulder, we have the head, we have another shoulder. We only enter after the break of the neckline. Yeah, this was when the neckline was broken. It broke and gave us a retest. At this point, you can beautifully enter. You could even enter at this bearish candle, and then you take a trade. Your stop loss could just be above the neckline, and then your target below here. This will be target 1, and then looking at the previous history, you can get yourself a target 2, and that is how you trade it. It's just very easy. Every concept that I'm talking about here, do yourself the due diligence to go look at your charts, historical data, plot it, see how it works, and that is how you learn. I want you guys making profitable trade and sending me screenshots of your profits, because your wins is my win as an educator, as a coach. Your win is my win. So everything I'm talking about here, the effort we are doing to teaching and your effort taken to learn, make sure you go back test your charts, look at your charts, practice it, and see that it actually works. All right, that is it. I want you all to move forward. Now, this is our double top. Okay, some can call it the M pattern. The double top, it's the same thing. Multiple double tops about the same level. When you see this double top, that means okay, this market is actually buying, but for some reason buyers are not able to break this spot. That is a resistance level. Okay, they're not able to break this resistance level, they're not able to break this point. What happens? That means the market is about to sell. But you don't just enter blindly. You want this level to be broken. The market could sell and come all the way here and then keep going up. That is why you have to wait for the neckline level to be broken. Then you can take your trade and targets here. Here, your target could be all the way to the zone or even lower. All right, and then your stop loss could just be above here. That is how you trade, guys. Making easy, sweet profits. To make profit, you have to understand there's a between guesswork. Okay, guesswork, you cannot replicate the profits. But if you want to be consistently profitable, then you have to learn the right way. And this is what we're doing. Keep learning. You can take your notes, write this concept down, go back and review it, and you see it. I want you guys to practice this on your demo trade. Send me the screenshots from your demo trade. You can now fund. Before you fund an account, you can always ask me. I will review your trading first. Then you can now fund a little account, practice what you've learned, because you're learning the right thing. You're practicing yourself, getting yourself familiarized with it. You trade the demo for a while, you see results. Now, you take that same results, trade it on a little account, and make sure you stick to proper risk management and your trading strategy. Trade that small account. That same result should replicate. All right. From there, we keep on going forward. Maybe taking the prop firm account to keep on going forward. Don't worry, I'm here to guide you and coach you from ground zero to ground 100 as God helps me. And I'm willing to go with you as far as you're willing to go with yourself. All right. So great students, keep on learning. Now, this is the double bottom pattern. All right. It must not be the same line, but just about the same line. This is double bottom, but we don't just enter blindly, right? We only wait for the break of the neck line. After the break of the leg line, this is it. This is my beautiful break. After the break, I enter. This is a good confirmation to enter. You enter and you keep on buying. That's how it is. Okay. So everything made easy for you. This is a triangle, asymmetric triangle pattern. Our triangle was formed. Pretty good triangle, right? After the candle was formed, this was our break. You could just enter after the break and your stop loss. This is a wick. Some could put their stop loss at the body of the candle, but I preferably like putting my stop loss just above this level, right? Above the wicks, to avoid market manipulation and losing my trade. And oh wow, I lost the trade later. I went to my favor. Stop loss just above the wick, and my target all the way to the most recent swing, most recent psychological level. Now, this is a good target from previous history. Obviously, you make your targets, and at this trade, you're getting 1 is to risk and 3 is to reward from this type of beautiful trade. This is what I see, proper risk management. Imagine when you're risking 10%, you found this trade, you take this trade, you've scaled yourself up to 30%. Even prop firm traders, imagine, let me say you're risking 2% of your account or maybe 1% of your account, taking this trade, you're coming out either 6%, okay, or 3%, but you're scaling up, and this is the right way to trade. Proper understanding of the market and proper risk management all the way. Still moving on forward. This is another beautiful example of the symmetric triangle. Another beautiful example. This is the symmetric triangle. After there was a break of it, you enter your trade, your stop loss. Like I said, this is a perfect stop loss. You can put your stop loss here or even all the way to this level, just depending on how many pips it is. Okay, you put your stop loss and then your target. This is our next target, most recent significant high. This was the supply level. Okay, our target is there, and then voila, our target has been achieved. Beautifully how you make your trade. Okay, now your stop loss here could be 40 pips, depending on what you have in your account. You know the lot size you want to use. You manage your lot size, manage your risks. Don't risk more than what you cannot afford to risk, so you don't have a lot of panicking and you don't have to blow your account. I personally recommend 10% on a live trading account. If it's a prop firm account, don't risk more than 2%. Just it's best to risk only 1%, 1.5, but no more than 2%, and stick to a certain risk that you're taking. Stick to a risk percentage and follow it all through, and that is how you make rewards. That is how you make profits. If you're doing this and you're not seeing results, come and DM me. But if you're doing this the right way, sticking to a certain risk percentage, not going in too high, a live account 10%, a profit account 1%, which is very highly recommended, and you're trading good setups and you have a win ratio of over 50%, it makes it difficult for you to blow your account. But if your win rate is 50%, you'll be ranging around break-even trader. But if you're only taking trades that are giving you at least 1 is to risk and 2 is to reward, then eventually you break out of the break-even because you should be expecting 50% out of it. Do you understand? That is if it's a live account. If it's a prop account, keep on doing that patiently. You pass your prop firm account, pass phase 1, phase 2, you get funded, you make your withdrawals. That is how it is. You need proper coaching, you need mentorship. We're here to guide you. All right. Still on moving forward. Did the same thing, beautiful examples. All right, all these are just examples to improve your knowledge. This I am doing to ensure that you're learning well. So do yourself the due diligence, go back to historic chart data, everything you're learning here, go try it out and see how it actually works. This is an ascending triangle, multiple tops at the same level, but then the bottoms kept on rising and rising. You draw your trend line, you wait for the break. After the break, you take your entry, and then voila, you're beautifully riding in profit. And that is how it's done. Now, this is a descending triangle. The peaks, the lows are at the same level, but then the highs are just by getting a lower high, a lower high, a lower high, but then the bottom are actually at the same level. You draw your triangle, wait for it to pass, wait for it to break. After it breaks, what next? You enter your trade, and voila, you're riding in profit. Doing things the right way is the right way to get the right result. Don't go inventing what is not, but follow what works and enjoy your result. This is it. Ascending triangle. After the break, you wait for a retest, proper break, as I said. Always wait for a proper break. This is the best way I love to do it. After a break, all right, I take my entry, not just blindly. Okay, I want a candle to tell me, okay, it's time to buy, maybe a bullish engulfing candle or some type of candlestick pattern, or typically beautifully a break and a retest. We take our trade, our stop loss to be here. That's it. Same thing here, same thing here. All these things, you can go back to these videos as much as you want. Please make sure you are practicing what you are watching here. That is the way to actually grow and make yourself this result. So here's another exercise on this part. Identify and draw the head and shoulder pattern on any given chart. For everyone that is in FriendsFOREX and DeluxeDealers, make sure you do this assignment. All right, identify the head and send it to us, the admins. Okay, identify the head and shoulder patterns on any given chart. Analyze a chart to find and explain double bottom and double pattern. You will see that most cases that these things occur, over 70% of the time, it actually goes as it is said. And then when you're trading like that, following exactly what you have learned, then your risk to reward ratio still at least 1 is to risk and 2 is to reward. I tell you, this is the way to make consistent profits, not just guesswork. But when you've repeated something over time, that is no longer guess, it's a skill. So you have to learn as we are teaching you, all right? So you have to know how to identify them. Identify your head and shoulder pattern, identify the double top, double bottom, see how the market plays out, and then you understand this is how it goes. Then you trade it out on the demo accounts. Recommended, I say 30 days, 60 days. Make sure you're trading the same strategy. But this alone is not enough to form a strategy, because I want you all to be pro traders. This was the intermediate phase. This alone is not enough to make you the high gains and the high consistent figure incomes. But this is a good stepping stone. So make yourself do the due diligence, practice, do the practice, try it on a demo account and see some profit. All right. But before you go live, you can always come and ask me. All right, let's move on together. I have spent a lot of money learning in the Forex market. I have lost a lot of money. I have blown a lot of accounts. So let my fails help you forward, so you don't have to repeat those fails. That is why we're here to coach you. All right. Good. Awesome. For more learning, you can go to Baby Peeps or Investopedia, or you can always reach out to us as your admins. I'll be here to guide you. Now, let's go on to indicators and oscillators. All right. Now, very commonly we have the moving average. Okay, we have the moving average. The moving average, they have different variations. We'll talk about two here: the simple moving average, which is the SMA, and the exponential moving average, which is the EMA. Now, the average price of a currency pair over a specific period of time. Now, these lines, they calculate and plot in the form of line dots, which are counting up as a line, the average price of a currency pair over a specific period, depending on the setting. Here we have 200 period, so it counts it on 200 period. All right. Now, the exponential moving average still works on the same principle, but the difference is this: exponential moving average place more emphasis on the most recent price changes. Okay, so that is why, if you notice it, some say and most say that exponential moving average is more recent and is more faster. Indicators tend to be lagging. If you're able to analyze the market without indicators, it makes you faster at analysis and faster entry, faster exit. But if you're relying on moving average, it tends to be more slow. Indicators are known to be lagging. Now, among the SMA and EMA, EMA is more faster than the SMA. That's just what all these things say. Now, crossover, how we get to trade with this. Whenever, okay, there's something called the bullish crossover. It's called the bullish crossover, or we can call it the golden cross. Is a short, like where the shorter term moving average crosses above the longer term moving average, it actually indicates a buying opportunity. Let me explain this. Now, if we have in our charts, we have the 50 EMA or SMA and the 100 EMA or SMA, and then what happens? The shorter one, the shorter period, that is the 50, okay, the 50 should cross above the 50 should cross above the 100. That tells us that, okay, this market is about to buy. Most people, without any other technical analysis or anything, they just enter the buy trade, and yes, over 50% of the time you're still profitable practicing this. Now, the dead cross here, the dead cross is when the shorter moving average crosses below, okay, crosses below the long moving average. This is what we have here. All right, so this is the dead cross. It crossed it, it went below it. All right, it crossed it, it went below it. The market is selling. Now here, if you cross it and go above, the market is buying. Please, guys, make sure you're practicing everything that we are doing. I want you all making money from the forex market to the kingdom of God, to the glory of God. I want you all to do well. So that is why we're taking our time to make everything for you as easy as possible. So do your due diligence to only practice. All right, now we have something we call the RSI, the relative strength index. Okay, is a momentum oscillator. It calculates the momentum. It tells you when the market is exhausted, when the market wants to rest, when it wants to breathe. Let me give you this example. Whenever this RSI, okay, passes the 70 level, in most cases the 70 level, it actually tells you that this market is overbought. The price has increased, appreciated a lot. This market wants to retrace. This market might start selling. In most cases, when it gets to the 70 RSI, when the RSI gets to 70, level 70, it counts from level 0 to level 100. 70 is telling us it's overbought. Then 30, if it goes below 30, level 30, it's telling us that, okay, this market is oversold, is undervalued. When something is undervalued, when something is oversold, eventually it begins to appreciate in value. This is this chart that I'm trying to see here. Here the market went below the 30 moving average. Looking at it, looking at your chart, then got yourself a bullish engulfing candle. This is a sign to enter. Your stop loss, your target is just here. You target, boom, you've made a profit. Now when the market got here above the 70, here is this is the 70 line. Okay, it got to the 70 line. What did you get? You get yourself a good sell. It doesn't mean that all your strategies should just be based off on this. Get other confluence. Let these strategies that you're learning, let these indicators, let these charts, these chart patterns you're learning, combine them together to make trading decision. That is how you communicate. Communication is not just done with one thing. Communication, let me say human communication, facial appearance, the person's tone, the message and everything. So you have to get confluence to know the exact thing the market want to do. Don't just use only one thing. Get yourself some confluence to make your trade, and then you have yourself a trading strategy. That is how it works. Now there is something that is very beautiful. I love, even up to today, I use it very well. It's called the RSI divergence. Okay, it's a signal that occurs when the price of an asset is moving in the opposite direction from the relative strength index. Because normally the relative strength index tends to move in the same direction with the charts. But anytime you notice there is a change in the both of them, that is a divergence, as the word says. Now, where it occurs and how it occurs will let you know if it's a bearish divergence or a bullish divergence. So whenever it is a bearish divergence, you know that there's a potential that this market wants to sell. Observe it what the market sells. If it is a bullish divergence, you know there's a potential this market wants to buy. Observe it well and the market buys. But you don't just take your trade at random. You want to see your candlestick telling you, okay, it's time to enter before you enter, or you get other confluences, as I said. Now look at this market here. The market was going up. We have ourselves a higher high, right? This is a high, this is a high, higher high. Okay, the highs were high here. Then here, what do we get? We got ourselves a lower high. Here, this was a high and this was a high. But if you look at this high was higher than this high. This is a here we get a higher high and a higher low. Here we get a higher high and a higher high. Here, this is it. Price forms higher high, but on the RSI forms lower highs. This was the most recent one, was lower than the previous. Normally it was meant to be higher. Also, another thing that happens, this formed above the 70 line. We remember what we said, when it is above 70 or at 70, it is actually overbought. Chances are this market wants to reverse. Beautifully, we notice ourselves a divergence. This is a very good trade entry. You take your sell trade all the way, you ride it, making your profits all the way down here. So please make sure you are taking notes. Make sure you practice everything that we are telling you here. Now let's look at this scenario. This is called the bullish divergence, bullish divergence, where the market is going to appreciate after a divergence occurs. Price here forms lower lows, okay, as you can see here, lower lows, right? Lower lows. And then what happens on the divergence? RSI. The RSI give us here, in this case, we got ourselves a what? Higher low. That is a divergence. When you see that divergence, you just observe. Wait for your candles to tell you it's time to enter. After that, what happens? You take your entry, and then beautifully you find yourself you take your entry. After that, beautifully you find yourself in good profit. That's how trading works. Okay, so bullish divergence indicates weakness in downside momentum. Remember, RSI is a momentum indicator. The sellers are getting very weak. Also, this you can call it at a demand level or a support level. You see that as an RSI divergence. These are all the confluences I need. Look, firstly, it came to a support level. Remember, when the market gets to a certain level, it wants to buy. You can also call it a demand level, depending on what you see in the chart. Okay, it came to a support level. Let's keep it at that. It came to a support level. After that, what do we see? We saw that the market was overbought, oversold. Remember, when it gets to 30, less than 30, that means this market is undervalued, it is oversold. It will most likely buy. Two confirmations, right? Then what next? We found ourselves. What type of hammer? This is a hammer pattern. You can call it a hammer pattern. We saw ourselves some bullish confirmation. This was a bearish pattern, but this is, some people can call this is another formation, tweezer top, but it's not yet good enough. What do we get? We got ourselves an indecision candle. Anytime I see myself having a divergence, I want to enter. Beautifully, it happened around what, guys? Around the support level, and then we got our hammer confirmation. What next? You take your trade. Your stop loss will just be below the wick, and then your target. Target 1, target 2. That is how it goes, and then you find yourself in profit. So make sure you learn. You can always go back to this video to rewatch if anything is unsure, but please make sure you practice. Practice makes perfect. Another indicator to look at is the MACD. MACD is an indicator that shows the relationship between the moving average and what? The currency price. Okay, it's just a relationship between the price action and the moving average. So MACD consists of a MACD line, a signal line, and a histogram. This is the histogram here, this red and this green. Okay, the signal line is the golden line, and then the MACD itself is this blue line, okay, or dark purple line. Now, when the MACD line crosses over the signal line, it is a bullish signal, but when it crosses below the signal line, it is a bearish signal. Here, what do we have here? This crosses, right? This crossed. What did we get? A bullish signal. The market bought. Then what do we have here? It crossed again at this point. What do we have? Market sold. What else? Still going down. This is another good sweet entry. What do we have here? The MACD line did what? It crossed below the signal line. It came from under it, like trying to push it up. Yeah, that means the market is buying. You take yourself a buy trade, and voila. So trading this alone still put people in profit. What else do we have here? See this type of candle formation. You can call this in a morning star. Okay, morning star, you take a trade, your stop loss here, your target, take profits 1, take profit 2 from another history, and then that's it. That's how you make money, guys. So we're teaching the right way to learn. The rest is for you to learn. The rest is for you to practice. Okay, we also have something called the Bollinger Bands. Okay, the Bollinger Band is a volatility indicator. It measures volatilities to say, okay, when the price comes to the upper band, indicates oversold. The market is oversold. It's overbought, sorry. When it comes to the upper band, the market is overbought. Then what happens when the market is overbought? It wants to calm down. It wants to sell a little, give us some sales, guys. So some people can just take their sell from there, but please don't just blindly take a sell. Make sure you're trading in alignment with the trend, or when the trend has given you a confirmed change before you take your trade. Now, looking at this, all right, this is a good trading entry. You take your trade, your target. Some could even target this lower band as a target. Some could target previous history, which is here, targeting previous history. That's how it does. That's how it goes. Now, another unique feature of a Bollinger Band, okay, Bollinger Band, when the market, when you look at the Bollinger Band and the bands are contracting, it tells you that, okay, the volatility is low. When the market volatility is low, you don't really want to trade because you waste a lot of time without much movement. Remember what we talked about trading sessions. Trading sessions, why you need to trade an active trading session, the volatility is going to be high, then you can get to make yourself a lot of money. Bollinger Bands can tell you if volatility is high or low because they begin to compress. This is it, the market was compressing. But when it is high, it begins to do what? Expand and enlarging, it gets wider. That's it. You can just use it for volatility indicator. Okay, also that's it. Another people fine-tune strategies around the Bollinger Bands, but I'm just giving you ideas on how you can trade the Bollinger Bands. Look at this level now. This market was contrast, low volatility. At the open of the session, the market came to this level, giving us a bullish engulfing candle at the lower band. You can just take a trade here, your stop loss here, and your targets here. But this is not a good trading strategy. Please, I am not the one advising you to do that. Always make confirmations, confluences. Look at every other thing and don't just take one thing. From everything I've shared with you, you can even carry 3 out of them. Tell yourself, when these 3 align together, I take my trade. That is how you form your trading strategy. It doesn't have to be difficult. It doesn't have to be so bad. But please make sure that you don't just relying on one thing. Merge them up. It doesn't mean you should have a lot of indicators on your chart. No, I'm not saying that. Your chart should not look your chart should not look messed up like most beginners. I trade a naked chart, price action. We're getting to that, but these are the fundamentals you need to learn. All right, you don't need to have much. You can just start with RSI, waiting for RSI divergence. You can start with RSI and MACD if you want to rely on indicators. You can just start with RSI or even RSI and moving average. You don't need to have much inside it. And then for entry, now use your candlesticks for your entry confirmation. Even without indicators, the candle patterns tell you when to enter. So please, from everything I have shared, I want you guys to start making profits, even as an intermediate trader, as you keep on advancing forward. All right, beautiful. Now moving forward. Now this is a very good example. Here, what do we have here? We just have our support moving average. Also, the market came to what? A support level. It got to a support level. Moving average. What did this moving average telling us? That we should buy from here. Remember what we talked about? Buy from here. Support level. You want to do what? Buy, because the market wants to buy. Also, the market is actually on an uptrend. It was in an uptrend. You want to buy in an uptrend. Is at the support level. You still want to buy. More confirmation. You got your crossover from the moving average. And then what happened? Some even can even draw a trend line. We have a trend line here. When the trend is broken, like when the trend line tool is broken, you want to take your trade. How do I put this? From this triangle pattern we talked about, you can draw the bottoms here. Okay, draw this. You wait for the break. After the break, you take your entry. So all these things are just confirmations on how you can trade. Beautifully here, I love the type of candles that I was seeing here. Summing it up, we got a very good bullish break to the upside. Multiple confirmation. You take your trade, your entry, your stop loss, and then voila, you're riding in profit. So please, this thing just shows you MACD and trend line entry strategy. Also support level entry strategy. Here we got multiple confirmation. First confirmation, it was at the support level. Second confirmation, we got the MACD. Third confirmation, the trend line was broken. Fourth confirmation, the candlestick confirmations. These are all you need. All right, you don't need to have much. You even have to have 4. 3 is enough. You enter your trade and make good profit. But remember, please, practice make perfect, and then you get yourself a strategy. You keep on fine-tuning and improving your strategy. All right, let's keep growing. Intermediate traders still make money. Intermediate traders make a lot of money. So keep on learning and keep on learning. Now, still moving on forward, guys. What do we have here? This is the RSI. Remember, oversold when the market, the RSI goes below 30 level. That is oversold. That means the market wants to buy. Oversold, what happens? It began to buy. But you still look at it well. If you can zoom this well, if there's a colored chart, you find yourself an entry, you buy, you enter the trade one, could be here. Eventually what happened? Our target one was eventually smashed. After our target one was smashed, the market now came going higher than the 70 level, and then we got ourselves a good selling trade. And that's just it, guys. That's just it. It doesn't have to be so difficult, okay? But don't rely on just one indicator. Get multiple confluences. That is what I've been hyping here. And remember, to advance as a profitable trader, that is still much to learn. All right? But these I have shown you, doing them makes you profitable. But to do them, you have to practice it. I can't stress this enough. Go and check previous history, historical data, plot these things, and see how the markets react around it. It will really improve your confidence in that strategy. And no matter how confident you might want to be, please and please do not neglect proper risk management so you don't wreck yourself. All right? I want you guys to grow the right way. I have made a lot of mistakes, so I'm teaching you the right way, so you don't go repeating that mistakes. Remember, that is this thing I like to say. In life, if you want to learn from someone else's experience, it's beautiful for you. You will not have to make a lot of mistakes. All right. But if you so ignorant to learn from other people's mistakes, that means you have to learn from your own mistake. And when you're learning from your own mistake, guys, you're in for a rough ride. So if you want a rough ride, continue learning from your own mistakes. Eventually, you will learn from your own mistake. That's how life is. But it saves you a lot of harm when you learn from other people's mistakes. All right, learn from other people's mistakes and learn from your mistakes. When you see the MACD tool, when there was a cross, we took our buy, and when he told us to close our trade, we closed our trade and began to sell here. That is how the market works. We sold, we bought, that's it. But remember, it's more better to follow the trend. What do we have here? We have ourselves an up trend. So you're here, you're only doing what? You're buying. When you see this sell, you close your trade that is already buying for you. You wait for another confirmation. This is a support level, right? You wait. This is our support level. Looking at this was a resistance level. It got broken. It began to act as a support level, still as a support level, still around the support levels when the MACD told us to buy. What happened? Remember, you want to buy at support and sell at resistance mostly. Don't find yourself buying at resistance. You only do that when resistance has been broken and confirmed that it's no longer a resistance, but now it's a support level. And what do we see here? We find ourselves an entry. Here we just got two entry confirmations, all right? The MACD, the support level. If you even go further, you could find yourself a candlestick entry. You find yourself a candlestick entry. This is a different type of chart, okay? This is a bar chart, not a candlestick chart, all right? So that's it. Now, still on the Bollinger Bands. You only take signals in direction of the overall trend. Please, the trend is your friend, so don't fight the trend. Following the trend will put you up in more profits. That is all we're trying to say. Remember, the Bollinger Bands, when it is contrasted, when it's close together, that is low volume. But when it is widening and expanding, that tells you a lot of volume is coming in. Yeah. Still moving on forward. As I always say, please try these things out. Exercise, okay? Check out EMA and SMA. All right, simple moving average and exponential moving average on any given chart. Okay, use RSI to identify overbought and oversold level. You can keep it as simple as this is. This is how you practice. Okay, so please keep learning. Now, for additional resources, you can visit Investopedia or TradingView. Of course, we always have TradingView as traders, so please make all these things and practice everything you need to know. Yeah. Now, Fibonacci retracements. Fibonacci's are very beautiful. It helps you identify when there is a retracement, okay? Because the market, even though it is an uptrend, it doesn't just buy indefinitely. You have highs, lows, high, lows. This is how it goes. Higher high, higher low, higher high, higher low. This is it. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. Now, retracement tools tell you when the market wants to retrace, then you can enter. Remember, you want to buy at a cheaper price and sell at a high price. You want to buy at premium zones and sell at discount. You want to you want to buy at a good level. That's what I'm trying to say. Okay, now retracement, it is used to predict potentials, is used to predict potential level of support or resistance as the market retraces a portion of a move. How do I, let me break this down as I've already said. Resistance, Fibonacci resistance retracement tool helps you identify the level at which the market will get to for a retracement, and then you can now enter in direction to the overall trend. All right, so let me show you this in a practical example. This is it, for example. All right, this is a retracement tool. You draw your retracement tool. The market coming at our golden zones. We call these golden zones around our 0.6 level. We enter our trade, continuing with the downtrend. Imagine if you don't know about this retracement tool, like see the market is actually on a downtrend, you blindly just go and enter from this point. Doing that, this market will go against you a couple of times before you eventually see it coming back in your favor. Funny thing, your stop loss might just be around here. You blow your stop loss, you're losing money. So with a retracement tool, if the market is going in a certain trend, use that retracement tool, plot it, wait for the market to come into that zone, then you can find yourself an entry. This is what we got here. More better, clear example is this. This is it. This market was in an uptrend. You don't just blindly buy if the market has gone ahead of you. You plot your retracement tool, you wait for it to come back to our 6.18 levels. That is a good level. I'll show you the good levels to trick. You wait for the market to retrace. After you retrace, look, it came in here, giving us a very good candle confirmation, and voila, you take your trade. Your stop loss will be above this level, flat support level. Your stop loss will be here, and then your target all the way. This is your take profits one, and then keep moving forward. It's original trend, and this is what we see here. We not just enter, we waited for ourselves, giving us a good candlestick confirmation. You take your entry here, your stop loss above this level, and your target all the way down here, or even this previous low, and that is how you make your profit. Okay, now this is my own chart that I decided to share. This is how it is as well. The market was in a downtrend. You will not just buy at random. You will not just go and buy here and make unnecessary loss. Now, the retracement was occurring. You drew a retracement tool. It came back around our 0.5 level, and then we took our trade. So you want to sell. See, let me. You don't want to sell around here. You really want to sell around the zones. All right, at least let it tap our 0.5 level or 50% retracement or zero stop loss above the zone and your targets here. That is how the retracement tool works, guys. Very easy to understand. Now, exercise. The retracement tool is on your trading view, all right? On your trading retracement tool on historic price action and see where the market reacted of. Use it. Use even the extension level. Extension level helps you know how far the market can go, all right? Use it to set your targets. With the extension level, it shows you where you can put your take profit 1, take profit 2, take profit 3, and thereabouts. Hence, the market continues in that same trend, all right? To know more about it, you can go to babypips.com or even Investopedia. Also, you can access more questions. Now, this brings us to the conclusion of the class, guys. This was an awesome journey. Thank you so much. Remember what we talked about, okay? We talked about the Fibonacci retracement tool. We talked about the head and shoulder patterns. We talked about the moving average. We talked about the MACD. I also showed you beautifully what I love to do, my own favorite, my own personal favorite. That is a RSI divergence. Okay, please, I encourage you guys, practice and apply the strategies you have learned. Make sure you do that. If you have access to us, send us a screenshot or you can just drop a comment. Practice it. We are a learning community. We're a learning hub. All right. So thank you so much for joining me. Thank you so much for joining me. Continue with us. Next week, we'll have more sessions. I will have more sessions. We'll continue this. This is for 8 sessions. So far, we have done session 1, session 2. We still have 6 more power packs, valuable sessions to go. So thank you so much for your time. This was an awesome one. Yeah, tonight we call it an end. So please and please make sure you practice everything that we have talked about here. Go through it, learn from them, and let's keep moving forward. I want you guys making profit. Practice it, look at it, try it out on a demo account, and see how trading works for yourself. Let's keep going. Thank you so much. Until next time, this is